You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast, where we are going over sections of Becoming Your Own Banker by Nelson Nash. On my previous podcast a couple of weeks ago, I talked about dividends at the end and how their correct classification is actually return of premium. I just wanted to add that Nelson goes into a lot more detail on this topic and describing the dividends in his book. I'm kind of just lightly giving an overview, but of course, to get into that depth and really have a fuller understanding, a more full understanding, I would definitely get a hold of a copy and go through it and take a read. One of my favorite things that he points out in the book is how the dividends can get larger and larger over time and can actually get pretty significant. He talked about how he had a well-seasoned policy that was paying an annual dividend that was 10 times the annual premium. Now, this doesn't even include the guaranteed crediting rate or the interest rate that the full account balance is earning. So can you imagine his excitement when he sees his dividend come through and it's 10 times his annual premium? This is definitely an exciting part of being able to teach you or clients when I'm talking to them or talking to you. I get to make sure of your understanding of the concepts of the book. Hopefully you've read it, but going through some of those concepts just to make sure they're crystal clear, and then get to go over some options and suggestions for your policy. And that's when I get the opportunity to describe the dividends and what's happening with the interest and how it's snowballing, and just you can really see what's happening. It is really exciting, and that's one of the most fun parts to teach through. Now, of course, just because Nelson had the experience of witnessing one of his policies have a dividend that's 10 times his annual premium doesn't mean that's what happened with all of his contracts or that that's what's going to happen with your contract. It's definitely different for everybody, and it depends on how much you're funding, the age you started. Of course, the companies are going to return different dividends over time. Those are not guaranteed, and it's going to be what it is. But having experienced that and being able to see and witness the projection of dividends becoming much more than the premium you're paying is very, very exciting. Now, from there, Nelson gets into the topic of human life value and goes back to the example from earlier of the man who's willingly giving away over 35% of every after-tax dollar that he earned, that he's giving that away to interest, that 35%. He says it should be obvious that his need for finance is much greater than his need for life insurance protection. If he would solve for the need for finance through dividend-paying life insurance, he would automatically have much more life insurance and recover all the interest he is now paying to someone else. But this almost never occurs because of the mental block implanted by financial geniuses that life insurance is a poor place to store money. Now, I just thought this was so well said, I just wanted to read it right out of the book. That's one thing that people don't realize or think about usually, is that by solving for cash, as in efficient cash growth of the policy, your cash value account, a lot of times the life insurance need will be fully met, or at least almost fully met. Sometimes it's way more than fully met. It's way more insurance than the person even thought they needed or wanted to apply for. Although I don't know if there's such a thing as having too much insurance. The insurance company won't allow you to have more than your human life value. And your human life value is likely to be less than what you're going to earn in a lifetime. So I don't know that there's such thing as too much necessarily. I mean, I haven't come across a person yet who had a death benefit and said, that's too much. You sent me too much money. Why don't you keep some of that or send it back? Or any of my colleagues who have had large death benefits to give out to people in the midst of a tragedy, nobody's ever said that's too much. In fact, If they would have had more, it would have been okay. Although sometimes the amount of funding someone wants to put into their whole life policy because they really want to load it up with cash, sometimes it's so high that the underwriter doesn't want to approve the death benefit. Remember that in the eyes of the insurance company and the underwriter, the primary focus of this plan is still life insurance. And so we sometimes run into this obstacle of wanting to fund in such a way that the death benefit doesn't make sense to the underwriter. They say that's more than your human life value. We're not going to do that. Not possible. Although this obstacle is definitely not common for most people, I don't run into it very often. The insurance company they just are looking at your human life value and trying to determine how much you're earning now, how long you're likely to work in retirement. And so they're using a calculation that's basically saying, yes, how many years to retirement and how much do you earn right now, multiplying that out and saying that is your total human life value. Now, the company does already have a calculation and the amount of years they're going to use and the multipliers at different ages and all of that. So it's not as clean cut as you saying, hey, I'm 30 and I plan to work to age 75. What's my human life value? They do have cutoff ages that they already are using, and we can't get them really to change it. That's just their guidelines. Another thing that Nelson points out in this section called creating your own banking system through dividend paying life insurance is how we're able to cut out the middleman when making purchases, such as a car purchase. Insurance companies actually sell blocks of money to finance companies who then turn around, mark it up, and loan it out to their car customers. I bet you've never heard that before, but you never suspected that when you've gone in to buy a car and then get financing for that car, that you are borrowing money that the finance company bought off of a life insurance company and then marked it up before loaning it to you. Nelson said that he had never seen a monthly list of investments from a dozen major life insurance companies that did not include finance companies as a place where they have loaned blocks of money. So now, had our all-American young man funded a policy with a larger premium than the base premium, than the bare minimum, and that bare minimum premium buying a bare minimum of life insurance, if he would have instead funded his life insurance policy with a larger premium than the base premium or the required premium, then he might have been able to borrow from his whole life system after just a few years of funding. Nelson, in his book, gives 4 years as an example. So he could have gone out and bought that car in cash had he overfunded his whole life insurance policy. Then we would, of course, have encouraged him to pay himself back with interest to replenish the funds that he borrowed. Nelson always said that the interest rate we charge ourselves should be at least the same rate that the finance company was going to charge us. And if we did this, then we would be essentially earning what the finance company would have earned and on a tax-free basis. And even better would be to repay the loan even more than what the going interest rates are at the time. And we will only end up with the excess that we can then put back into our banking system to grow your system. The problem comes in when you feel you shouldn't have to pay yourself back with interest, with more interest than you'd pay a finance company, or maybe at all. A lot of people will say, well, this is my policy. This is my money. I shouldn't have to pay myself any interest, or I should be able to completely control it. Maybe I don't want to pay myself back at all. Then you must think back to the grocery store example and realize that by cheating yourself, you're really just stealing from yourself and doing a major disservice for yourself, your banking system, your future self, and your eventual legacy. But instead, by paying yourself back, by paying your banking system back with an appropriate amount of interest, you will be building up your cash to be put back into your existing policy as paid-up additions. Or if that policy is full to the rim and no more funds can be put into it without mecking the contract, which remember means causing it to become taxable, then that may be the opportune time to expand your system altogether. As Nelson points out, he's not just talking about one policy, but a system of policies. Just like you would expand your reach As a business owner with a regular retail type of business, by acquiring new locations, you would want to expand your banking system whenever you have the resources and it makes sense to do so. So, just like the grocery store business does business with other people than just you and your family, you can also use your system to help others. You can loan money to others when it makes sense. You just would want to make sure that that person that you're loaning money to is trustworthy and is going to pay you back and with interest. Well, this concludes a very good section out of Nelson Nash's book. And just as I said in the beginning, for the in-depth details of what I'm going over, you should definitely pick up a copy and read through it. You will have an even deeper understanding of the things that I'm talking about. Nelson's words are just so full of wisdom. Also, if you've got a copy of the book, you should review the basic understandings and review part 1 section at the end of part 1. Nelson does a very good job of summing up the sections and summarizing them. Well, as always, thank you for tuning in and listening to the show. I appreciate every one of you and look forward to meeting those of you who are ready to move forward and take a look at how implementing this strategy can positively impact your life. If you're feeling ready and would like to partner with me as your coach, feel free to reach out to me. You can reach me at Valerie@alphaomegawealth.com. I hope you have a wonderful rest of your week as we kick off December. And wow, I can't believe it's December already. This holiday season from September to December is my absolute favorite time of the year, and I can't believe there's already less than a month left of December. It goes so crazy fast. For that reason, I hope that you soak it all in and have a wonderful December and time making memories with your loved ones this holiday season. Thanks again, and I'll talk to you again next week. Take care.
This is thepodcastfactory.com.